So if you ever start working at a bank, one of the first things you're probably gonna have to do is transfer all the investment accounts into the bank that you work at. The reason for that is because banks wanna keep a close eye in all the things you're investing on, since you might have access to a lot of material non-public information, and they wanna keep tabs to make sure that you're not doing something that you shouldn't be doing. So recently, when I started working at the job that I have now, which is at a bank, I had to transfer all my accounts from Fidelity to the bank. The only issue was that before at Fidelity, I basically paid nothing for trading. And now at the bank that I'm at, where all my accounts are, I have to pay around $14 for every single trade. So it was a great opportunity to sit down and look at my portfolio and basically sell all the things that I wanted to sell before I transferred my account to the bank. That way I can save some money on commissions. So here's what I did. So one thing that we always mention in this channel, and I learned this by all the personal finance and finance books that I've read, is that I focus in indexing the majority of my portfolio and then picking individual stocks with as little money as possible. What that means is that the majority of my portfolio is invested in the S&P 500 and the NASDAQ, but there's a few positions that I've liked over the last few years that I put money into. However, once again, I was proving that the majority of the money that I put into individual positions, I just lost money because, like we always say, it's very hard to outperform the market. So when I sat down and decided to liquidate my portfolio, the stocks that I decided to liquidate were the ones that I already had a big loss on, or I just didn't see a lot of upside potential. So I ended up selling 8 different positions. I'm gonna list them out from the smallest loss to the biggest loss. So the first one was AT&T. I was gifted money to buy AT&T on my 21st birthday because it's a stock that doesn't move that much and pays a lot of dividends. I ended up selling this stock at around a 10% loss. I only had 2 shares, so I only lost like $4. But if you add up all the dividends I received, I probably netted at 0. So not that bad. The second one was Jets. Jets is an ETF that tracks all the airline companies in the US. I decided to put money into it just like Barney did because we bought it in the pandemic and the time that all the airlines were doing really bad. And it actually turned out to be a very good investment at around mid-2021 because after that it just started going down again. So it turned out not to be the best investment. I ended up putting around $775 and I sold at around a 17% loss, which means that I lost around $133 because I ended up buying 35 different shares. So that was actually my biggest position in the portfolio here. The next one is Blackstone. I decided to buy Blackstone around 2 years ago because I read the book What It Takes, which is the founder of Blackstone. I do not regret this purchase at all, and I was actually positive at a time, but just because of what everything is happening in the economy, the position went very low. I lost around 30% of my position here. I actually think this was a good purchase, but I realized that just buying 1 share of a stock that you have like an emotional attachment to might not work. You should only try to do that investment, or at least it's my opinion, if you have a lot of money that you can actually make like a big investment on. The next one is kind of a weird one. It's an ETF called Buzz. The idea of this ETF was that it was going to use an algorithm to track pretty much all the hashtags and all the trending topics that were going on in the world. And then it was going to invest in stocks based on all the things it was picking up about pretty much the things that people were talking about. I decided to invest on it because it was recommended by Dave Portnoy, who's actually a big investor of Buzz. And he never ended up talking about it again because the stock did horrible. I ended up selling 45% down in my investments, which meant that I lost around $45. Now, the next investment is kind of a weird one as well. It's an ETF called Bets. It tracks all the big gambling companies, and I decided to purchase this one pretty similar to Jets because it was during the pandemic when all these gambling companies like DraftKings, Penn, and all these other positions were doing really bad. Once again, it went up in mid-2021, but now, once again, all the gambling companies are doing really bad. So I ended up selling at a 48% loss. It wasn't that big. I only lost around $70, but once again, I could have put that money into something much more useful and balanced. The second to last one is Vine, which is kind of the most weird investment that I did. I kind of purchased this as a joke. Vine is the wine company for Nina Dobrev, an actress that I really, really like. And I decided to buy it because it was her company. I ended up selling at a 75 4% loss, which was like $8. So it was more of a joke and it was funny, so I don't regret it that much. Before I give you my biggest loss, I'll give you the only stock that I made money on, and it was Pfizer. I bought Pfizer in, I think it was like mid 2020, because I believed that it was gonna be one of the companies that was gonna release a vaccine and make a lot of money out of that. And I turned out to be right. I put around $180 and ended up making around $75 after that when I sold. I sold in December when it had gone up because all the positive things that were going on, like the vaccine, etc. So that was the only stock that I made money on. And my biggest loser, it wasn't that big an amount of money, but it was a big in percentage, which was Astra. Astra is an aerospace company that was recommended by a family member, which shall remain nameless, and ended up losing 96% of my investment, which was around $40. So all in all, I sold 8 positions, 7 of them which were a loss, and I realized a loss of $261, which is not huge. The positive thing about this is that I will declare that against my ordinary income and I can actually deduct it, which won't really do much of a difference. And the only positions that I actually kept in my portfolio are the Nasdaq positions, the S&P 500 positions. Both of them I have across SPY and also a few mutual funds that Fidelity offers. And I kept only 2 single stock positions, which are Penn, the company that owns Barstool, and also Dave Portnoy, because like you can see, I'm a big Dave Portnoy fan and I actually think they're gonna make a lot of money in the future, so I'm fine holding that for the long term. And Amazon, which did horrible in 2022, but I purchased it after the stock split, which was when it started going down. I am a big believer in Amazon just because I can take out my phone, press 2 buttons, and I have whatever I want on my doorstep the next day. So I think in the long term, it's gonna have a lot of value. But with all that being said, here are my biggest takeaways and my new rules that I'm gonna have for my portfolio. So obviously over this time of sitting down and reevaluating my portfolio, I basically came up with 3 rules I'm gonna follow more closely now going forward. The first one I call, don't run a hedge fund. Before I decided which stocks I was gonna sell, I actually sat down with a colleague that has been working in finance for much longer than I have. And the first thing he said when I saw my portfolio was, you're trying to run a hedge fund. What he meant by that is that I had way too many single stock positions and I was trying to act pretty much like a hedge fund. As we know, even hedge funds that are professionals do not perform in the market that often. So basically this rule translates to not having a lot of single stock positions. The second one is only buy if you can buy enough. So let's say in the future I want to buy stock X because I think stock X is gonna go up by a lot. So I put $100 and stock X actually ends up going up 25% and I ended up selling at 125. So I made 25%, which is great and it's probably higher than the market did. But I actually only made $25. What this rule means is that if I'm gonna take a position in a single stock, I'm only gonna do it if I have enough money that if that stock goes up, I'm not gonna feel bad that I didn't put more money into it. If I put $100 and the stock goes up by 25%, I'm gonna feel bad that I didn't put more money into it. But if I put $1,000 and it goes 25%, I'm gonna make $250. Obviously, you're always gonna think, I wish I could have put more money into it. But making $250 against $25 makes some difference. So my new cutoff is gonna be around $500 to $1,000, which is a lot of money for me, but it's gonna take away that chance of me feeling bad that I didn't put enough money into it. And lastly, and the most important and the most basic and the one that I always say is keep indexing. Being in the market is always gonna be hard and I try to stay away from it as much as possible. And actually, if you've seen my videos from a few weeks back, my new goal is buying 100 shares of SPY. That way I can do cover calls. But let me ask you, what are your goals and what are a few tips that you have for your portfolio? Leave it in the comments, I'll check it out, and subscribe so you can see my next video about the progress that my new portfolio takes me. Peace!